And when you talk about low price for buying some sort of fundamental, whether that's cash flow or earnings or the book value of a company, if you pay less, you can expect to earn more. And I think for those who've listened to the show a lot, now you suddenly start to hear how we're talking about what a lot of people think of as value. And you're looking for good value. A common factor I know that comes up in academic circles and within industry conversation is the value premium, the value factor in general. My question to you, I suppose, is that there's a lot of ways to be a value investor. So how do you think about it? Because it has perhaps evolved over time for a number of people.
Yeah, yes, and that's reasonable. Look, science evolves, knowledge evolves, data availability evolves, and so we have to evolve. You like it or not, and we have been evolving. Everyone has been evolving. You have been evolving, and so it's good to embrace this evolution of knowledge. And so, yeah. So how do I think about value investing? As you say, is buying good value. So paying low enough price relative to whatever you are thinking about, that seems to be a good deal. And if it's a good deal, it means that you have high expected returns, higher than the market expected returns. A reason why not to buy the market, but to buy something else. This is such a good value to me that I'm buying this instead of buying the market, or mixing it instead of just buying the market. So if you go back to the restaurant, so why price matters? Because I can tell you, 3-star Michelin restaurant, super amazing one, and I tell you this has a low price. So okay, that's good. I can tell you a restaurant that has not 3 stars. Let's say they have only a mention or just half a star. I don't even know if that exists. And I tell you, at the same price than the previous restaurant, yeah, a 3-star restaurant at this price and a no star restaurant or half a star restaurant at the same price, what's its value for you, Peter? And probably you say, it's the same price. The other one has amazing food, amazing service. I go to the 3-star one. Okay, that's value for you. If I tell you the same, I say, no, now I'm telling you, the half a star restaurant is 1/10 of the price of the other one. They say, oh, maybe I don't have such a good food, but it's still good enough for the price that I'm paying. So that's value for you. So value is what you get relative to what you pay. So, okay, when you were speaking about companies, what are we buying when we're buying a company? We are buying the company's future earnings, and we are buying the balance sheet, the equity of the company. So if you think about that, you know, I want to pay as little as possible for those future earnings and that balance sheet. You know, that's why you buy a company. So what we think is, hey, I want to buy a company that has good profits, yeah, good profitability, good balance sheet at a low price. And depending on the relative value, the relative comparison between the price that you pay and these other two fundamental variables, some companies are more attractive than others from the expected return point of view. Same as the two restaurants that we spoke. If you tell me a company has low earnings, but the price is extremely, extremely low, that may be a better deal than a company that has high earnings and the price is a little bit higher. So that relative comparison between the company fundamentals and the price is what allows you to say, well, these companies seem to have higher expected returns than these other companies. These companies that have higher expected returns are a value buy. They're a good deal to buy, and they're expected to deliver more than the rest of the market. And so our value strategy is focused on those companies.
Now, a lot of people listening, if they've ever traded in individual stocks, that might all sound familiar to them to say, yes, when I was buying individual stocks, I was trying to find the ones that were cheap relative to their earnings or their cash flow or their book value. But the research indicates that it's better off to buy all of the relatively cheap companies as opposed to picking whichever one you think is correct. Can you give me a little insight into the empirical research on that? And at what point in time you have enough exposure to a number of different stocks to achieve that diversification benefit and still benefit from getting a higher expected return from buying low priced stocks relative to their fundamentals?
That's a great question. So why do I need more than one stock if I can buy one that is the cheapest one? And the answer is simple. We know information as in the most simple way. We know information as of today. Yeah, that company is well run, has good earnings, the price is super low. Everything sounds great. Yeah, but tomorrow there may be new news. The CEO takes off. The company has a new competitor coming into the market with better technology. So there is a lot of uncertainty around all this. The moment that you have uncertainty, it's not a sure bet anymore. If you have uncertainty, you want to diversify that uncertainty risks. And so why? Because I may have a company that has very similar characteristics, also low price, so also high expected return company, and I'm more diversified. I have less uncertainty if I have both of them, because it's all that both of them will have the same bad news coming, probably one or the other, or probably none of them. But the more that you have of these companies around, the more that you diversify that uncertainty about, for example, future possible bad news. And so it's not that you are sacrificing expected returns, because you are finding a group of companies that have low price relative to these fundamentals. So you're not sacrificing expected returns, but you are minimizing your risk. You're minimizing this uncertainty about, for example, future outcomes that are not known today. And so it's kind of a free lunch diversification if you think about that. It's a saying, why to take so much risk and be in love with that particular name, that particular stock, if I can have similar expected returns, minimizing that particular idiosyncratic that we call company-specific risk. So you're just better off. It's just common sense. If you go back a long time, like 80 years, 90 years, these concepts were not completely understood. People were thinking about expected returns and not completely thinking about the trade-off between expected returns and diversification, risk management. That's understood today. There are things that we don't know that hopefully we will get to know more and more in the future. But that's understood very well today. There is a trade-off. You want to be diversified. And many people say diversification is like a free lunch. You are not giving up much, but you are really, really getting benefits from that being diversified.